Since 1972, the McIlvaney Financial Group has been a conservative, contrarian investment firm. With that mindset, they have created a multifaceted approach to portfolio management, offering a wide array of services including hedging through precious metals, wealth advising, a unique short fund, and an excellent educational resources. We have had David McIlvaney on our show multiple times because we respect his outlook, viewpoints, and recommendations. You really need to take advantage of the free portfolio risk analysis and bank safety ratings they're offering our listeners. Just call them at 1-800-525-9556, and you will be put in touch with an advisor with years of experience who can take 15 minutes and give you a much better understanding of what true portfolio diversification is. Again, call them at 1-800-525-9556 and benefit from their expertise. Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. He is Chief Strategist and Chief Economist for Clarity Financial. He's the editor of Real Investment Advice. His articles appear on top investing websites like MarketWatch and Newsmax. He's the talk show host of The Lance Roberts Show, and he's the author of the Real Investment Daily blog and the Real Investment Report newsletter. Lance Roberts, thank you for joining me.
Absolutely. Glad to be here. Thanks for having me.
Yeah, I'm surprised I haven't had you on sooner since we have a lot of mutual friends, but I'm glad to speak to you right now. And I actually saw some of your great articles on LinkedIn in the last couple months. They're really good. So we'll talk about those later in the interview. First, though, I want to ask you, Lance, about a lot of retail money coming into the stock market, really since Donald Trump won. I've heard a lot of hedge fund managers talk about this, that a lot of money has been going into index funds, basically indiscriminately buying either the FANG stocks or other large cap stocks. What's your opinion on this, and how does this have to do with stock market valuations?
Well, it has a lot to do with a variety of things. It has a lot to do with stock market valuations. It also has a lot to do with the current, I would say, liquidity issues that's going on with some of the particular larger cap stocks as well, because we have a big influence. And of course, just a quick sidestep here is that one of the big kind of topics as of late has been the demise of the active manager. Everybody's going passive now. We're all buying ETFs and we're just passive indexers. That is a huge myth in the markets. And the reason is why. It's just like us in my shop where we manage money. We manage a portfolio of ETFs. We also manage an equity portfolio. We also manage a blended account of both individual equities as well as ETFs. We're not passive indexing. We both buy and sell those indexes in order to gain exposure to certain areas. So by no means are we investing passively, and this is the case for many advisors and many portfolio managers that have moved towards using an ETF type model for cost efficiency, for expediency, for effectiveness, and also to lower cost and to provide a product that, quote unquote, all of Wall Street is now telling individuals that they must be in. Why are you with an advisor using mutual funds? Buy ETFs. So there's been this big rush of capital into ETFs that's creating a distortion in the prices because the ETFs have to buy the stocks that make up the ETF. So if there's 30 different ETFs that all own Apple, when everybody runs in and buys those ETFs then acquire prices of Apple. Apple then moves up. And of course, that is beginning to create a discrepancy in prices between metrics such as valuations, price to sales, price to earnings, etc., that wouldn't normally exist if investors were doing due diligence and looking through fundamental valuations and buying equities that way. One other note about this is that in 1999, we were going through the dot-com craze. You were crazy if you didn't own a dot-com stock because it was all about eyeballs per page. In 2007, it was all about real estate. In 2016, 2017, it's all about ETFs. And we are once again creating a very late-stage herding into an asset class. And, of course, we're seeing a lot of commentary coming out about, being in ETFs and these type of issues, got to be a passive indexer. The problem is going to become when the market ultimately reverses, whatever causes the reversal, when people begin to move from being a passive indexer to a panicked active seller, a vacuum will appear in prices, and the gaps on the downside of this are going to be historic.
Yeah, BlackRock and Vanguard, I think, have over 4 trillion in assets for their broad general stock market index funds. You talked about buying individual stocks and ETFs. You know, there, for our listeners out there who aren't familiar, who aren't financial professionals like you and me, you know, there's a difference between a sector exchange traded fund or ETF where you're buying the oil industry sector or gold mining sector or something like that, and buying the entire stock market on a S&P index fund at a low cost. So, you know, I think
That's right.
Yeah, so I think, you know, a lot of money, like you said, has come in there, and it's pushed valuations to ridiculously historic levels. I think, Lance, we're one of the foremost overvalued stock markets of all time on a bunch of different metrics, whether you're talking the CAPE ratio or others. It's up there with 1929, 1999, 2007, and the current stock market valuations. It doesn't mean we can't go higher, but, you know, if you're a buy and hold investor, I would not be adding to positions at all.
Well, and that right there is an excellent point, which is somehow we get lost in these late stage market cycles, and of course there's a lot of exuberance right now that the markets are going to go higher. Of course, every day there's articles written that, well, you have to be invested in the markets and you can't time the markets, etc. We tend to forget that, first of all, throughout history of investing, there has never been a great investor ever in the history of the world that says, my strategy is simple, I'm a buy and hold investor. Because long term, there's two things that happen. First of all, you don't have long term. While a lot of advisors point to, well, the S&P has generated an 8% annual rate of return on average for the last 130 years, that's a true statement. But the problem is that you didn't live 130 years to achieve those goals. The one thing that we don't have is the ability to live indefinitely to achieve long-term valuation structures. When markets are overvalued, as they are now, when you're trading at 25 times earnings, historically over the next 30 years, because of the price that you're paying for an investment, your returns are historically very low, somewhere between 0 and 4% over the next 30-year period. And that's throughout history. So the price, price is what you pay, value is what you get, is what Warren Buffett once said, and he's absolutely right. And this is the thing that we forget, is that as investors, we are buying into a future stream of returns, and if we overpay for those returns, we're not going to be very satisfied with the outcome. But consistently, because of greed and because of what we're told by the media, we get pushed into this herding effect that we completely detach from the fundamental basis of investing, which is that we have to manage the risk of the capital that we put at work into the markets. And without managing the risk, we're going to destroy future returns.
Great points. And, managing the risk, people would have had a heart attack if they would have kept on buying and holding all the way down during the 2008 financial crisis. I mean, there was a lot of professionals that did buy when there was blood on the streets, but the average retail person didn't put any extra money in. They didn't start buying until things were already up again. So, I mean, no, I was just going to say, you're right. The reason that investors couldn't put any more money in at the bottom is because they didn't sell out until they got to the bottom. So, they just got out of the market in late 2008, early 2009. That's when they sold out. So, of course, they didn't come in. Of course, people talk about the market's returned 200 and something percent since the 2009 lows. Nobody invested there. Most investors have not gotten back into the markets until the last couple of years in particular. They didn't participate with those gains. Here's an interesting statistic for you, by the way. If you take a look at the daily price action of the market going back to 1900, the market has spent about 4% of the time actually making new highs. The rest of the time was making up previous losses. That's very interesting. Do you think the current stock bull market, I think it's artificial. I think central bankers, not only the Federal Reserve, but others have pumped a lot of extra liquidity into this bull market, and it's not really fundamentally driven with the asset prices going higher. Do you think we're seeing large signs of the stock markets topping now?
Well, here's the way to look. The answer is we don't know. A couple of things we have to understand. First of all, there's a lot of attention paid to the amount of leverage. We talk about record margin debt. We talk about record corporate leverage. We talk about record household debt, etc. there's been a lot of articles written as of late saying, well, margin debt really doesn't matter because it just means that the market's going up. Let me explain to you something very clear. Valuations, margin debt, price to sales ratio, enterprise value to gross value added, all of these metrics all suggest that the markets are in a very late stage advance. But it doesn't mean that the markets are going to crash tomorrow or next week or the month after or even a year from now. The psychology that drives market prices higher has an ability to go longer than anybody can possibly imagine. But here's the point. All of those factors, especially something like margin debt, is like gasoline. And I can set a can of gasoline on the floor of my house, and my house is okay. The can of gasoline is completely fine. It's inert. It will do nothing to my house as long as nobody gets near it with an open flame. The problem is that at some point, and I can't tell you what it will be, and it will always be something that we don't know. When the markets know of a risk, we tend to price it in very quickly. Geopolitical risk, North Korea, Russia, China, economic risk, bank risk, we tend to price those in very quickly. The thing that gets the market is the thing that we don't know is going to come, and it comes out of the blue, and it surprises the market, and it causes the markets to begin to sell off. And when the markets sell off enough, it ignites the gasoline, and that is the margin debt. That's your corporate debt liquidation. Those are your high-yield defaults, et cetera, which begin to fuel selling. As the selling begins to become fueled, that triggers more margin calls, and you have a collapse within the market as people are forced to liquidate out of positions. If you want to take a great look at an example of this, go back to 2008. And yes, everybody goes, well, yeah, that was the financial crisis. Doesn't matter what part of the market cycle you were in. The early stages of the decline in early 2008 and April and May and June were fairly orderly. We were building a head and shoulders pattern on a technical basis. We broke the neckline. There was a clear signal to get out of the market. We sold out of the market at that time. But it wasn't until September the 15th when we're all sitting around, and if you lived in Houston, you'll remember this date because that weekend was when the Hurricane Ike was blowing into Houston, and it was also the same weekend that Lehman was forced into bankruptcy. That weekend started the avalanche of margin selling as credit markets froze in the next weeks that ensued. Out of the 52% decline in the market, 44% of that decline occurred between September the 15th and March the 9th. That was where the damage came. And investors never had an opportunity to get out of the markets when it occurred. So the biggest problem we have now is I can't tell you what is going to trigger it, and I can't tell you when the event will come, but because of the leverage, the excess, and the exuberance that we built into the markets, we will have a correction of a minimum of 30 to 50% when it comes, and it will happen rapidly, and it will leave investors breathless. And if you got out of the market today, shut your eyes, and came back in 2 years, you will be better off than you will be 2 years from now.
Now, Warren Buffett says that the market is still cheap based on his look of interest rates. But if the Federal Reserve were to, say, continue raising interest rates, even 25 basis point interest rate increases, do you think that could break the bullish confidence that stock traders have right now, and that could be the Black Swan?
Well, it's not just it's not the movement of interest rates, okay? It's the result of what you do when you move interest rates. So as an example, when you begin tightening interest rates, you impact other areas of the market much more rapidly. It was the hiking of interest rates, it was the tightening of the interest rate market that ultimately led to the collapse in subprime loans. It led to the collapse in the mortgage market. Back in 2000, it was the hiking of interest rates that ultimately tripped the economy into a recession. The same thing will happen here. Now, the differences is that back and of course, this is an excuse that's often given, which is, well, interest rates are cheap, so therefore we should be able to sustain much higher valuations, and we're going to just have an economy that continues to run for years. It's going to be phenomenal. Well, the problem is that back in 1999, when we were hiking interest rates, we had a 4+% growth rate in the economy on a real inflation-adjusted basis. Therefore, when I begin hiking rates, I have to go from over 4% growth to 0 before I even get to negative. In 2007, we were running above 3%, so I have to decline from 3% down to 0 to get to negative. Today, we ran at, in 2016, our economic growth rate was 1.6%. You don't have to go very far to go from 1.6 to 0 and be in a recession. Furthermore, today, because investors and individuals are more levered than ever, rising interest rates impact things like credit cards, subprime auto loans, etc., and we're carrying more of that debt now than we were in 2007. So in a weak economic growth environment with weak wage growth, with 80% of households living with no more than $500 of emergency reserves in the bank, you don't have to have a lot of interest rate movement in order to have an economic impact very quickly upon individuals. And that ultimately, when we get that economic downshift, that's where it begins to impact the markets, et cetera, and earnings growth begins to decline. The earnings growth that we've had over the last couple of quarters now has been from the rise in oil prices. If oil prices can't get back above $48 a barrel and we reverse to lows, which is a very big probability this summer or later this year because of the increase in supply, that earnings growth is going to evaporate out of the market. And we've got a very narrow leadership right now with just a very few stocks leading the market higher while we have the number of stocks above their 50 and 200-day moving averages declining. That tells you that the market is weak and that you don't have a lot of wiggle room before you trip a trigger that leads to a bigger decline.
Now, you brought up oil prices. I know you live in Houston, Texas. I have other oil contacts who also live in Texas, and they're always too, I guess, optimistic and bullish about the oil price. When I go on oilprice.com and I see articles like oil prices slip as the U.S. rig count continues to climb, that has me worried that, we are going to have a big oil bust in the near future, and those problems, Lance, are going to spill over into all the other asset classes.
Yeah, look, I have a large number of clients of mine that are in the oil and gas field. I have a lot of very close friends of mine that are actual drillers. They're out there drilling fields. They are drilling, and they're very excited about the recent bump in prices, and they are getting out there to drill. But they're not drilling because they're excited about a future where oil prices are climbing back to $100 a barrel. They're drilling because they want to stay in business. Remember that oil companies, their revenue comes from the oil that they pull out of the ground and that they sell off. If they're not pulling oil out of the ground, they can't pay payroll, they can't pay debt, and they go out of business. So they have to drill, and they have to figure out a way to drill in order to generate some revenue, in order to take advantage of the ability to stay in business. So yes, they are drilling. They're excited about the recent pop in oil prices, but they are extremely cautious. You take a look at the forward curve and the belly of the option structures that they're currently using, and they're betting that 2 years out right now that oil prices aren't any higher than they are at the moment.
That's trouble for the oil industry because, the oil
Absolutely.
the costs have come down for some oil companies, but, we're not producing a lot of low-cost oil right now. It looks to me, Lance, like a lot of the deep water companies are going to go out of business. So unless they will. Yeah, so I think we're going to have some huge problems in the oil industry. And we know, these national oil, it's perverse to me, you'd think in more of a capitalism-free market that when the oil price dropped, people would drill less. But with like the oil countries like Saudi Arabia and Venezuela, it's perverse. It's the opposite. They seem to want to, increase oil production because they need to make up for lost revenues.
That's right. And the problem is now is that we are doing a lot of drilling out in the Permian Basin, and a lot of this has to do with companies that have a lot of outstanding debt. So one thing people don't understand is that the surge in oil prices and the surge in oil production from the shale when we began this big shale production. If you haven't looked back in history, you have to go back in history to the 1970s and look at where we were in terms of supply relative to global demand. We had a huge amount of supply back in the late 1970s, and when we went through the Arab embargo and those type of things, we began to shift a lot of production back here domestically, and oil supply fell to very, very low levels, and we stayed there for a very long period of time, and then began to ramp up production again, going back into the early 2000s. But it wasn't to a great degree that we were creating a massive amount of production here in the United States relative to the demand that was given on a global basis. Prices rose in 2000, leading up to 2008. Most people don't remember that in 2000, at the turn of the century, most people don't remember that oil prices were trading between $20 and $30 a barrel at the turn of the century, just 15 years ago. And then we went to $150 a barrel during the 2000 run up to 2008. After the crash, and we went back to $38 a barrel in 2009. That was when the Federal Reserve came in. And when the Federal Reserve came in, that money that flowed into banks came in and was piled into oil and gas shale drilling. And that was where the shale drilling boom went crazy, and supply has now gone back to the same levels we were back in the 1970s. But the difference this time is that demand on the global demand curve is not increasing to the same degree. Global demand remains weak, and it's going to get weaker because of the efficiencies. Our cars are more efficient. Our houses are more efficient. We're now doing electric cars. We're now pushing more for green energy technologies. And while those are nascent products at the moment, it is eating into the global growth demand for oil itself around the globe. So this is leading to an inability for supply to rebalance with global demand. And when you cut 1 million barrels, Saudi Arabia cuts 1 million barrels in production, that's great. But if we turn around and produce 1 million barrels more, and really we produce much more than the 1 million barrels now in the increase in shale production, you're not reducing the global supply. And you take a look at supply, the supply-demand curve remains inverted, and supply continues to rise while demand weakens. And this is going to continue to lead to these collapses in oil prices and the need for somebody to come out and say, oh, I'm going to cut production. But Saudi Arabia is only going to do that for so long. They're only going to sacrifice so much market share before they start producing again. It's about their economy as much as it is about anything else. And we keep thinking that, well, they're just going to keep staying out of the game. They're not. And when they come back on again, you can probably bet that we're going to see sub $40 barrel oil again. And this is going to put a lot of these companies back on the auction block.
It's a great analysis of the oil market right there. Yeah, I think Saudi Arabia and Russia and those countries, they're so dependent for their tax revenues and funding their government and social programs on oil revenues that, at this low oil price, they're in a lot of trouble. You talked about the oil production cuts with Saudi Arabia, but there's long histories of so many of these OPEC countries cheating. So who knows how long they're going to stick to their promise of their production cuts. So if they start cheating and produce more oil, that's going to put more pressure on the price as well with even more supply. I think Wall Street, Lance, I've talked with some people about this too. I think Wall Street has funded a lot of these shale oil companies like they have technology stocks, that they only care about the revenue growth and the other underlying fundamentals of the company. They don't care about free cash flow. They do debt for equity swaps. There's a lot of financial problems underneath that a lot of people are not talking about with these companies.
I absolutely agree with you.
Well, you put out a great article last month. I want to really highlight this. It was on MarketWatch. It's called 10 Great Investment Mind Strategy Comes Down to This One Thing, and it's about maintaining your capital. So what you did in the article, for our listeners who aren't familiar, I'll put a link to the article, is you cited a lot of great investors, whether it's Jeff Gundlach, CEO of Double Line Capital, and you gave some tips to maintain people's capital. You want to talk about that some more, please?
Yeah, no, absolutely, and it was interesting because there was just an article out today, and on Twitter, and I was kind of going back and forth with the author because the author of the article wrote that, well, you need to sell your stocks before the next recession, and I was like, great point. You do need to sell your stocks before the next recession, because during an average recession, you lose 30% on average of the value of your portfolio during a recession. And then the author comes back and says, yeah, but you can't time the market. Well, the point is yes, you can't successfully time the market, but let's explain for just a moment the differential between timing the market and managing money. Timing the market, I will absolutely agree, you cannot do. You cannot time the market. And there are people that tell you that they can, and it's a personal preference, I think, more than anything else. But timing the market, the way I look at it, is where I'm trying to be all in the market and then all out of the market. So when I find a market bottom, I'm all in, and when I find the market top, I'm all out. That's extremely hard to do. It can be done, and I'm not saying that there's people that can't do it. I've never met somebody that can do it consistently. But the problem is it's a psychological thing, is that what happens psychology-wise, and when we know this by looking, we were talking about the crash in 2009, and investors didn't get back until, back into the market until just the last couple of years, because they didn't sell out to the bottom, and then they were wounded, and it takes a long time for that greed to get back in. And I just got an email today, as a matter of fact, from a guy that says, well, I've been in cash this whole time since after the crash, and I'm thinking about getting back in now. And I emailed him back. I was just, really? Question mark. But the point is that that's the psychology part. That's the human nature of investing, and this is why investors consistently buy high and sell low. And so timing the market's very difficult, because once you get out of the market entirely, it's very, very difficult to get back in. But now let's talk about managing risk, which is what I do. So, and this is the crux of the article that you're talking about, and I mentioned this earlier in an interview. Every great investor in history has a discipline. They have a strategy of some sort. And a lot of them, whether it's Ben Graham or Jeff Gundlach, Paul Tudor Jones, a variety of others, Warren Buffett, they all have a list of their investment rules, their investment guides, the things they adhere to over time, Seth Klarman and others. And all of them revolve around some simple basics. And we all know them, and we don't pay any attention to them. For instance, like buy low, sell high. We talk about it. We all know the rule. Nobody pays attention to it, because when prices are high, we should be selling now. We should be selling stocks. Stocks are at an all-time high. We've got excessive valuations. We've got excessive exuberance. Everything tells you that the markets are overvalued. You should be a net seller of stocks here, not a buyer. But yet what we have is a rush for investors trying to get into the markets right now, because they are afraid they're going to miss out. Well, they are going to miss out, and they're going to capture all of the next downturn when it occurs. Because when the market begins to break and the market begins to fall, they're going to be told all the way down, oh, it's just a dip. Don't worry about it. It's going to come back. And then when it goes lower, well, this is just a little bit bigger dip, but you got to buy now, because the market's going to come back and we're going to go to all-time highs. Ultimately, when we're down 30 or 40%, eventually the pain will become too great. The media still be pounding the table that, well, you need to buy. And at the bottom of the market, when they've lost 30, 40, 50% of their money, the media is going to tell you, well, nobody could have seen X, Y, Z coming, and if it hadn't been for that one issue, you wouldn't have lost 50% of your money. But if you didn't see it, you were stupid for not knowing that valuations were high to start with and this was going to occur. That's the reality of what happens in the market. So every one of those rules in that article are simply revolving around one thing. It's about understanding how to manage risk in your portfolio, because if you can manage the risk of loss, and that doesn't mean selling out of your portfolio entirely and going to cash, it's talking about managing risk. If I can manage risk against loss over time, the gains that I will make will occur as a byproduct of managing risk. Let me explain this very quickly. In a portfolio, when you're making money, there's some basic kind of tenets to managing a portfolio over time, which is when you have positions that are doing really well, you harvest gains over time. You let your winners run. You trim you sell your losers, let your winners run. But even when your winners are running, it doesn't mean that you don't trim them every now and then and put some money back into your portfolio. One example I use with clients quite often is to explain to them our money management principles, which is the same as tending a garden. If I plant a garden out in my backyard and I till the soil, I fertilize the soil, and which is basically opening an account and putting money into it, and then I plant seeds, I go buy stocks. My plants will grow as long as I water them. I continue to make contributions to the portfolio, and I continue to fertilize it. My plants will grow. Now, that's great, and eventually my plants will bloom, and I'll have tomatoes, and I'll have carrots, and whatever else I planted. I'm going to have a garden full of bounty. But if I don't go out and harvest that bounty, ultimately what will happen is it'll all die on the vines. If I don't weed the garden, sell my losers, then eventually my losers or my weeds are going to overtake my garden. And if I leave my weeds in the garden long enough, it will eventually consume the entire garden. This is the same thing that happens in a portfolio. We often look at our losers and say, well, I hope they'll come back eventually. I'm going to hold on to Lucent because Lucent's eventually going to come back. That just tells you how long I've been managing money. But, you know, and what happens is we wind up with a portfolio full of these stocks that we're hoping are going to come back someday, but that's creating opportunity risk, and that's dragging down returns in the portfolio, and eventually some losers never come back, and they go away entirely. If I don't trim my winners, and one thing I get a lot from clients is, well, I don't want to sell it because I'll have to pay capital gains tax. You should be happy to pay capital gains tax when you sell a position because you've made money. I can't tell you how many times that I've seen individuals that would not sell a stock because of capital gains, and they finally sold it when the stock turned back into a loser. Quick example, I had a client that came to me, and for 3 years prior to when before he came to be a client, he owned Citigroup. His broker in New York had sold him Citigroup. The stock was trading over $100 a share, I think, at the time, and he would not sell it because he had tremendous gains. He had bought it like at $10 a share. The stock had tremendous gains. It was his entire portfolio, and he was not going to sell it because that stock was a long-term investment, and he was going to invest like Warren Buffett. He finally sold the stock at $5 a share after the dividend was gone and after the collapse in 2008. The point is had he done just some basic money management along the way, he would have been far better off. Yeah, go ahead.
Excellent advice. Yeah, with that story with Citigroup, I mean, and Citigroup had to get bailed out, so he's lucky he even got those $5 a share. So, I mean, because of all the bank bailouts. So, you know, it's really sad. Yeah, people complain about so many different things. They need to have discipline. They need to be rational. But when people make investment decisions, unfortunately, you know, it tends to be more gambling. It tends to be with emotions like greed and fear instead.
Yeah, that's right. That's right. And you know, and this is why even in our portfolio management process, so we have a series of technical signals that we utilize to help us determine when to begin to reduce risk in the portfolio. So as markets begin to turn from being positively trending or being bullish in nature, when those signals begin to trip, and the market begins to turn from a more bullish stance to a more bearish stance, we begin to reduce exposure. But even when we reduce exposure, we never go to 100% cash. And the reason, and I learned this the hard way in 2009, in June of 2007, I liquidated all of our equity portfolios to 0% equity, and all we owned was fixed income at the time. We actually owned individual bonds. And in February of 2009, I wrote an article called 8 Reasons for a Bull Market. And if you'll remember back in 2009, the markets were heading down. We were breaking down. We were heading towards 600. We weren't there yet. I think we were still around 750 points, 750 on the S&P at the time. And I wrote an article, 8 Reasons for a Bull Market, was because we were so negative. People were so convinced the world has just come to an end. There were articles written why the S&P was just going to cease to exist. And I wrote an article about why to start buying stocks. And I started to go buy stocks in client portfolios, and I lost clients. They delinked their accounts and went away. And when I called them, I said, why are you leaving? He said, are you crazy? You're buying stocks and this is going to zero. I learned my lesson then. That was the psychological turning point. People couldn't make that psychological shift to buy when there was blood in the streets. So this is why we never go to 0% equity anymore. We'll reduce down to a very low amount of equity, but we always leave some equity in the portfolios now. So when we get those bottoms and the market begins to turn up, then we start buying into positions that already exist. So psychologically, it helps investors move themselves back into the markets because they already see a positive turn within the portfolio. But you know, this is about but it's all about managing risk. And when you manage the risk of the portfolio and you manage against the loss, you don't spend the next 6 years of the bull market just trying to get back to even. And that's the key, which is getting back to even doesn't inure to a long-term success within your portfolio because you're going to run out of time trying to get back to even. One quick note other than this, because I always get this question too. Well, I just buy dividend yielding stocks because I'm just going to hold it for the dividend. Let me remind you of one thing. In a bear market, the first thing that happens with a dividend yielding stock after it loses 50% of its value is they cut the dividend because the economy has begun to drag on revenues. And every time this happens, people learn this lesson the hard way. And over the last 8 years, people have been chasing dividend-yielding stocks. They've pushed those valuations to extreme levels. And during the next recessionary decline, not only will they lose a very large percentage of capital in their portfolio, which is going to hurt, but the second thing that's going to happen is they're going to cut their dividends. And now you've lost the capital and the reason for holding the dividend-yielding stocks. So this is something you've got to be extremely careful of.
Yeah, the story you talked about with the blood in the streets and the people saying you're crazy, that sounded like a good contrarian indicator. You basically have to be courage and conviction. You have to have strong mental acumen there to maintain your will when everyone else is telling you you're nuts, you can't do it. I was buying stocks too during the 2008 financial crash. After the crash, I was going in there and buying, copper miners that I thought would survive and other good dividend stocks. I bought Goldman Sachs for my dad too. Once I saw Warren Buffett got those crony deals. So I mean, so there's lots of bargains to be had. I have a couple more questions before I let you go.
Yeah.
You talked about a 30 to 50% decline in the near future for the stock market. We don't want to give exact time when it'll happen because I don't think anyone knows the exact time, not even Janet Yellen. But this is philosophical. Do you think the Federal Reserve will intervene again with more quantitative easing if asset prices do fall that much?
Well, first of all, it'll be at 1:03 p.m. on August the 27th. But outside of that, yes. No, look, there's no doubt that the Federal Reserve, central banks globally are going to intervene again. Will it limit the decline in the market? It's possible. There's a risk, however, that at some point, even those interventions won't work. The reason that the Federal Reserve knows that we're very late in a bull market advance. Let me rephrase that. We're very late in an economic stage, and they realize we're closer to the next recession than not. Therefore, they're not raising interest rates because they honestly believe the economy is firing on all 8 cylinders. What they want to do is make sure that they're not caught at zero, so they have an interest policy tool to work with at that point in time in order to be able to lower rates to some degree to try to minimize the impact of a recession. Quantitative easing does not actually drive into economic growth. It may boost asset prices for a period of time, but the problem is that it doesn't really spark a lot of economic growth, and we've seen that over the course of even the last 8 years. So the efficiency or the effectiveness of quantitative easing during the next recession may not be as good as people expect, and if the markets don't buy into that, then it may not be the help that ultimately the Fed wants. The other problem for the Fed is also going to be having enough liquidity out of the bond market to continue to issue QE. So they already own $4 trillion worth of bonds on their balance sheet. The question is how much more fixed income can they absorb on their balance sheet without causing a disruption to the bond market itself? Unlike Japan and unlike the Eurozone, which can buy actual equities, it will take a congressional mandate in order to allow the Federal Reserve to buy something other than either Ginnie Mae or U.S. Treasuries, because they have to buy assets that are guaranteed by the government.
Yeah, those are great points. I think, unfortunately, it seems like they want to change the rules. I've already heard Larry Summers and Ken Rogoff and Paul Krugman talking about, getting the rules changed so the Federal Reserve during the next crisis can go and buy more assets. So it's we're living in very interesting times right now.
Yeah, but again, that's not a healthy thing. People need to understand that, yes, the Federal Reserve can come in, and central banks can come in, and they can buy assets. But once the central banks absorb the assets of the markets, it doesn't help the financial structure of the economy. The reason we have a financial market is in order to lift the economic prosperity of the entire country. If you begin to do more and more of the same of which we've done, we continue to create this inequality of wealth within the global system as we have it. We continue to divide the uber wealthy from everybody else in the country. If we take a look at basic statistics right now, 90% of Americans are not really participating in the financial markets. You take a look at the number of people that have 401k plans. They've got less than a year's worth of salary actually saved up in their 401k plans. You take a look at a bulk of individuals, 80% of Americans are barely making ends meet. They're not participating in the financial markets to any great degree. So you are slowly dwindling down the economic prosperity of the country. And so, yes, you may ultimately wind up doing this again and again and again with quantitative easing. And every time you do this, you are going to number of people in the economy that are participating until you have 1% of the economy that's wealthy. The other 99% are literally going to be living hand to mouth, and you cannot create economic prosperity by doing that. Eventually, at some point, you're going to have to reset the markets if you want to create long-term financial and economic success for the country as a whole.
I completely agree. And I agree, too, that I think the Federal Reserve's intervention, it's caused asset prices to rise, and it really hasn't helped the real economy and people on Main Street. I have a very large podcast. I know your show's large. I don't get emails from people telling me how well they're doing, how they can go from job to full-time job to a higher paying full-time job easily, and they have tons of discretionary income. I hear the exact opposite, in fact, right, from most of my listeners. And, Alan Greenspan, before I let you go, Alan Greenspan has been recently saying that stagflation is here and it's going to get worse because, with the Austrian School of Economics, there's been a lot of misallocation of capital by all these central banks that, maybe they did intend to help out poor people and help out the economy, but that's not where the money's gone. So I think, the money has gone into, the higher asset prices and making the rich richer. And that's causing, big distortions throughout the economy. And one of those distortions, I think, is stagflation.
I absolutely agree. We're seeing that more and more by looking at some of the inflationary trends that are trying to happen. It's in very relegated areas, by the way. So you're not seeing it. And let's just very quickly, in terms of inflation, there is a good type of inflation and there's a bad type of inflation. Good types of inflation are the types of inflation that lead to higher prices in terms of the products, goods, and services that are being sold, but at the same time are causing an inflationary push in the wages that are being paid. And the reason that prices are able to go up is because as wages rise, consumers are able to pay more for a product, so the company that's producing the product, good, or service raises their prices, consumption still remains, because wages have come up and people can afford it. And this leads to this symbiotic relationship leads to stronger rates of economic growth. Go back to the 50s, 60s, and 70s as an example. Wages, inflation, and interest rates were all trending higher along with economic growth and savings rates. Everything was trending in an upwardly pushed direction because the economy was on a symbiotic push of rising inflation and rising economic strength. And the average household debt to income was about 60% back then. So people were able to save, buy what they wanted. We were manufacturing, we were producing, and the economy was working. Beginning in 1980, we deregulated banks and we began this explosion of debt. And, basically, if you wanted it, you could afford it because you could get it out on debt. We added $12 trillion in debt by 2000. We've continued to add on more debt since then. And we now have 140% of debt to household net worth. And at the same time, when this has occurred, we've had falling wage growth, falling economic growth, falling savings rates, falling inflationary pressures, falling the dynamics really kind of across the board as debt has continued to increase. So today we have inflation, but it's not the type of inflation where companies can go out and raise product prices because there's a big demand from consumers that are able to support higher prices. And this goes back to your interest rate point earlier as well, that if interest rates go up, it raises the cost of goods that people can't afford to pay. So there's a very quick resumption of people pulling back or curtailing spending when that happens. Take a look at what retail sales have been doing just since the beginning of this year is a good example of that. But as you have these inflationary pressures from things like insurance costs, healthcare costs, college costs, when those things are going up, those are a direct bleed on the ability of consumers to make ends meet. So again, most consumers in America, about 60% to 70% to 80% of them, have very little money in the bank. It's taking everything they bring home just to pay bills. So even small changes to prices have a big impact on families. So when things go up in cost, but I'm not having rising wage growth to offset those costs, it curtails my ability to consume, and we have weaker economic growth, which is why we continue to dribble along here at 1.5% to 2% growth. And so, yes, stagflation is a very big issue, and absolutely agree with Alan Greenspan.
Yeah, I think Keynes called it cost push inflation rather than the wage growth inflation. But I would like prices to fall. I would like deflation, beneficial deflation, like in technology, how flat screen technology has improved. You get more bang for your buck than 10, 15, 20 years ago when flat screens came out. So I would like personally to get more bang for my buck and prices to fall. But I'm an Austrian school economist. I want to thank you for your time today, Lance. I really enjoyed our discussion. If our listeners want to read your articles, which I think are great, and also your radio show, how do they do so?
Best thing to do is simply go by our website, realinvestmentadvice.com. All of our blog posts are posted there every day. The weekly newsletter that goes out every weekend is also there on the website. If you put your email address in, I'll email it to you. Every Tuesday, we do a technically speaking update to the markets. All of our radio shows, I have 2 radio shows that I do every day, 5 days a week. That are both on the website. Click on the media tab, and you can get all of the clips and sound bites from those shows as well. It's all at the website, realinvestmentadvice.com, and I appreciate the time.
I do too, and hopefully I can have you back on in the near future, and I think you're going to be a valuable contact there in Houston, Texas, because the oil industry could end up being one of those black swans for the next financial crisis, unfortunately.
I don't disagree with you. I'm happy to do it anytime.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.